$7 trillion changes hands in the global foreign exchange market every single day. It is a massive, relentless stream of capital. This diagram shows the core mechanic driving all of that volume. You are always weighing one global economy directly against another. When you buy a base currency on one side of the scale, you are simultaneously selling the quote currency on the other side. Open a standard trading terminal, and you will see dozens of individual national currencies combining to form hundreds of potential pairs. For a beginner, it is an overwhelming wall of flashing numbers. Faced with that wall, the natural instinct is to hunt for action. A new trader will look for the currencies moving the fastest and making the sharpest jumps, hoping that a high-speed market translates to rapid profit. But treating all those ticking numbers as equal opportunities is a trap. To survive your first months of trading, you need a systematic filtering process to strip away the noise and locate the safest possible assets. The first filter we apply to the market is volatility, and our immediate targets for elimination are what we call exotic pairs. This stack of Turkish lira represents one half of a classic exotic pair, the US dollar measured against a developing or emerging economy's currency. This chart reveals the danger. Instead of steady trends, an exotic pair's price violently spikes hundreds of pips. As it suddenly whips back, it slams into your risk thresholds. These erratic swings easily trigger a stop loss, closing you out before your trade even develops. Because the wild price swings introduce completely unmanageable risk to a small account, exotic pairs must be crossed off your list entirely. With the highly volatile exotics gone, we look at the remaining pool of currencies and apply our second filter, liquidity. This diagram illustrates a hidden cost dictated by liquidity. The physical space between the buy and sell price is the spread. When trading a minor pair lacking massive daily volume, the broker stretches that gap significantly to cover the risk of an illiquid asset. The mathematics of a wide spread guarantee that the exact millisecond your trade is executed, your account is immediately in the negative. You must overcome a steep fee just to break even. To protect your capital from being drained by transaction fees, you have to discard minor pairs. Focus only on assets where high trading volume pushes that spread near zero. Filter out high volatility, filter out low liquidity, and you are left with exactly one category on the terminal, the majors. Major pairs survive our elimination process because they are backed by the massive infrastructure of the world's largest economies, like the Bank of Japan shown here, supporting the yen. The continuous, massive global volume flowing through these specific economies automatically creates the tightest spreads available, while smoothing out the erratic price gaps that wipe out new traders. The majors represent the mathematical sweet spot of Forex. They provide enough daily movement to actually generate a profit, backed by enough stability to let you manage your risk. Even within the majors, spreading your focus across all of them at once will slow down your progress. You need to narrow your focus to a single anchor pair. Standing behind the euro is the European Central Bank. When weighed against the US dollar, the EUR-USD becomes the absolute best anchor pair for a novice, offering the highest liquidity of any financial asset on the planet. This infographic highlights the optimal window for trading that asset, the few hours of the day when both the London and New York market sessions are actively open and volume is at its peak. Specializing in this one pair gives you a distinct advantage. Instead of tracking global chaos, you can focus purely on learning the specific personality of this market and follow the direct economic reports from the Federal Reserve and the ECB. Master your anchor pair first to build a sustainable foundation. When you are ready to execute the strategy, open your terminal on FXNX, where you can trade the majors with zero